The South Sea Bubble of 1720 was a notorious financial event that occurred in England during the reign of King George I. This scandalous episode, often referred to as one of the biggest market bubbles in history, involved the South Sea Company and its ambitious scheme to take over the national debt. To understand the magnitude of this event and its implications, we must delve into the circumstances leading up to the bubble and the subsequent fallout. In the early 18th century, England found itself grappling with a significant national debt resulting from the costly War of Spanish Succession. The South Sea Company, founded in 1711, saw an opportunity to profit from this situation. The company proposed an audacious plan to take over the national debt by exchanging it for its own stock, offering enticing financial returns to investors. The South Sea Company's stock became immensely popular, drawing in investors from all walks of life. However, as the company's stock soared to unprecedented heights, driven by wild speculation, it became evident that the South Sea Company's promises were nothing more than an elaborate illusion. The market frenzy eventually culminated in the famous bubble burst of 1720, leading to devastating financial losses for countless investors. The South Sea Company's rise to prominence was not without controversy. Some influential figures, including Sir Robert Walpole, warned against the economic dangers of the company's schemes. However, many others, lured by the prospect of immense wealth and succumbing to the irrational exuberance of the time, pushed forward regardless. The speculative fervor that surrounded the South Sea Company's stock reached such heights that it engendered a culture of financial gambling and reckless investment. People from all social backgrounds, including the middle class and even servants, invested their life savings into the company's stock, hoping to secure a share of the promised riches. This unsustainable situation eventually reached a breaking point. In August 1720, the bubble finally burst. Panic ensued as investors rushed to sell their shares, leading to a swift and dramatic collapse in the stock's value. Countless individuals, including prominent figures such as Sir Isaac Newton and a significant portion of the English population, were financially ruined as a result. The aftermath of the South Sea Bubble was profound. The scandal exposed the excesses and vulnerabilities of the financial system, leading to a loss of public trust in financial institutions and a widespread condemnation of speculative investments. The British government, fearing social unrest, initiated investigations, and subsequently, those found guilty of perpetrating fraudulent schemes were severely punished. The South Sea Bubble marked a turning point in the regulation of financial markets. The event spurred the establishment of regulatory bodies, such as the Bank of England and the London Stock Exchange, with the aim of preventing such catastrophic crashes from happening again. It also laid the groundwork for future discussions on investor protection and the need for transparency in financial transactions. Reflecting on the South Sea Bubble of 1720, we are reminded that the allure of quick riches can often blind individuals and societies to the risks involved in speculative investments. History has taught us valuable lessons about the importance of prudent financial practices and the need to maintain a vigilant and responsible approach to investing.